Hey everyone, my name's Andy. My channel is Finding Value. If you like this content, please subscribe, click the thumbs up button. I'm going to go over previous commodity bull markets and how the comparison between today, the 2000s bull market, and then the 1970s bull market. So a lot of good content here. It's probably going to be pretty fun to watch and see what the differences are between the commodities bull markets. So going in here. Here we go, it finally loaded. So, the 2000 to 2008 bull market returns. So price returns. Gold went up 7.3 times, silver 11 times, platinum 6.3, uranium 15x, oil 10x, and nat gas 9x. And obviously the producers of these companies or miners were 4, 5, 6, 7 times what these are, these returns. So some of these company returns, gold, this is AUY, Yamana Gold, 71 times your money. AEM, which is a little bit larger company, 14 times. And you can see the differences between the market. This is a larger market cap, this is a small market cap. Paladin Energy, 1,300 times your money. MCF, 920 times your money. SM Energy, 20 times your money. Devon, 10 times your money. And then ConocoPhillips is a large company, 5x your money. So I prefer going after the smaller small caps and then spreading my money out amongst the different sectors. That's how I like doing it. The 68 to 1980 bull market. Gold went up 21 times, silver 37 times, platinum 10 times, and oil 13.7 times. The company returns, now this is kind of crazy. Many of them went 10 to 40x your money in only 2 years. And these are oil gas companies, uranium companies, and precious metals companies, all of them. That's 2 years, 10 to 40 times your money. They just blow technology companies out of the water for their returns. Peak oil happened in 1970. That's one fact. And the housing boom happened in the 1970s. So this period, with the large increase of gold, silver, platinum, this right here correlates very well with today. We're going to have a housing boom, and we could have a world peak oil boom happening very soon. We'll see. I'm not 100% sure on peak oil, but I think it's going to happen in the next 10 years probably. So current bull market, 2020. I see similarities between 1970 and today. We've got a housing deficit of homes, about 4 million homes deficit, and it's going to drive massive inflation just like the 1970s. They're also printing money like hell. Money printing and demographics all align like the 1970s. The baby boomers were coming into home buying years during the 1970s. Now we have the millennials coming into home buying years today. We've got massive deficits of many base metals in uranium production, just absolutely huge deficits everywhere. We've got peak gold that is approaching right now, so gold prices are going to go massively higher. We've got peak silver soon coming in terms of peak production of silver. It's going to decline while everybody wants it. It's going to go way higher in this scenario and in this environment. We have peak platinum production possibly coming up. I've heard a couple people saying the peak was in 2006, and now it's just when we ramp up into use more platinum in products, that price is the only regulator there. We've got massive debasement and a green energy ramp up. Massive debasement in terms of money printing. And peak oil possibly worldwide. Here is the scenarios of these bull markets. This was a huge bull market here. It was right when the housing starts came and peaked. Again, housing starts came and peaked in the expansion phase, and here we are going into another expansion phase for housing starts. Housing starts tells us if house prices are going to go higher, because when house prices go higher, housing starts follow. So house prices are going to go higher and housing starts are going to follow right now. We've got the commodity to S&P 500 ratio, cheap, 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 expensive, 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 70s bull market, 98 to 2008 bull market, and we're probably doing a 2020 to 2030 or a little bit thereafter bull market coming. Here is platinum production. Peak output, and here we are lower. COVID's in here too, so we're probably somewhere in this range, but it is lower, and this could be a long-term trend. This is gold supply. Forecasting 2020, decline afterwards. This is going to be huge in terms of prices, just absolutely huge. Mine production, this is silver producing. They are declining. I don't know if they're going to be able to bring this back up. We'll see if price goes higher, if they can actually produce more. This is a Hubbert's peak for silver, and they're projecting silver to be at a peak very soon here. We'll see. We'll see if that happens. And here is how much is left for me. This is oil, coal, gas, and uranium. Obviously, they go out pretty far, but if you look at silver and gold, 2030, yeah, if we tried ramping up all these materials, we could run into shortages, and price is the regulating factor. You could see much, much higher prices for gold, silver, platinum, and all these other metals that are out there that could potentially be at peak already. So, long-term holds. Are the metals finally hitting peak production? I'm not 100% sure, but it will be chronic shortages if it's true. Palladium and rhodium, obviously we are trying to use those materials more than what we can produce from the earth right now because they are byproduct metals. Soon to be silver, gold, and platinum. Those are soon to be chronic shortages. This would be evidence to hold physical precious metals, in my opinion. Physical versus companies, and I know a lot of people talk about this. The physical side, there's no business risk, no tax risk, no nationalization risk, no input cost risk, no operations, no COVID risk, limited risk overall, to be honest. And you can bet big money on physical precious metals. Big money. You can put a large portion of your money in it, and it's really a risk-free bet, or about as low risk as you can possibly get. It's less risk than even cash. That's how low risk it is. Companies, you can leverage the returns of the price move with some companies if you're good enough and you can find these small caps. You need to speculate in the small caps to get that leverage. But obviously you can choose the wrong companies. They can go bankrupt at the bottom. Usually you're allocating small amounts of capital and spreading it amongst many companies. They might have trouble extracting minerals in the future if we're at peak minerals with lower and lower ore grades, higher and higher costs. And if you get that compression in the ratios, where oil outperforms gold or whatever metal they're extracting, their input costs could be going up higher than the actual cost of selling whatever product or metal that they have. And you might have energy price issues. Yeah, that's what I was talking about with energy. If we do have peak energy, obviously anything that's a physical precious metal is going to be far more valuable than a company that has a bunch of metal in the ground, but they can't really extract it for a bunch of money. Because if energy goes up at a faster rate than the metal price, their margins contract. So, conclusion here. So I think we have a similar setup to the 1970s inflationary period. We've got real estate and housing starts positioned exactly the same way, and we also have the demographics aligning just like the 70s. If we hit peak oil in the USA and became a net importer of oil in this 1970s scenario, and it was mainly a USA problem in the 1970s. It was all constrained to the United States, and only the people in the United States kind of jumped in gold. Right now, what's different with the current one is we could be hitting peak oil worldwide. And I don't know the exact timing, but it's probably between now and 2030. I think that's a good bet. Physical precious metals might be more valuable compared to companies if we hit peak oil. So that's one way that you can play this, and one paradigm that you can look at it is that physical precious metals in your hands above the ground could be a lot more valuable than the metals in the ground with companies extracting it out of it. Because if you hit peak oil, the energy costs are obviously going to go very high. The metal price, you don't know if it's going to outpace the energy price. And so there might be these expansion, contractions, and margins for those companies. This is a worldwide problem. This isn't just the United States. So if this happens, you're going to see everyone run to something. So it's going to be much more powerful of a move. And it could be an exceptionally large move. It can make the 1970s move look like it was just absolutely nothing, because everyone's going to be going at it with all their money worldwide, possibly. Also, struggle to produce worldwide with nations having issues. What I mean by that is you could have a production in a certain country, and when they start struggling financially, they might just say, take over all the assets. So if you have a company that's in a different country, the risk of nationalization is pretty high. So physical precious metals is a much lower risk bet than putting money even spread amongst a bunch of small caps, because if half your small caps get hit, more than likely you're not going to have that same risk with the physical precious metals. Sure, they could be able to tax it, but there's ways that you can get around that if you really wanted to. And also you've got declining ore grades, which is going to raise the cost and also have a much higher input cost for energy use. So if energy goes up, you've got a lot more risk in terms of everything in a company that produces metals. So you've got the energy risk, you've got nationalization risk, you've got risk of the ratios compressing and contracting on you as energy might outperform gold at the later stages of the bull market. And that's what happened in the previous bull market in the mid-2000s, is that energy went far higher during that bull market than gold, oil, and silver. Same with the 1970s bull market. So these bull markets, the spot to be, I think, is precious metals physically. You have a couple of your mining companies, and then you have a lot in natural gas and oil, because those typically are the ones that just go absolutely berserk at the end of the commodities boom. Uranium's another good one to be in because that's a high energy dense metal. Uranium is a very good pick because that energy density might prove its worth. And on a dollar, if you do it from a financial basis in terms of energy return on the finances, it could be millions of dollars per pound of uranium if energy becomes a lot more scarce. And materials are going to get a lot more harder to get. So you can't just say, let's go build a green world in an energy scarce world, because you can't dig up all the materials to have wind turbine engines and solar panels all over the place, because getting the materials is now very energy constrained. You know, there's a big energy constraint to pull all this stuff up to make more energy, because the energy return on energy invested on renewables is very low. That's where your energy return on energy invested and the understanding of that comes into play. So how do we play all this? Oil and natural gas companies, uranium companies, get some precious metals companies, get some physical precious metals. That's how we play this. That's the strategy right there. Look at my other videos, binge watch them. You can see what's cheap out there. I'm a big fan of platinum. I was accumulating a ton of silver when silver was cheap right before platinum. I own mining companies of silver companies and gold companies, a lot of royalty companies as well I own. And I own uranium companies, and I own natural gas and oil companies. I own a whole wide diverse array of them. I also own some cannabis stocks after someone brought them up and the charts looked so good. This is Finding Value. If this content provides some value to you, please uprate this video and subscribe. Thank you.